I want to talk to you today about tax-free options for retirement planning. This is Bryan Pitstick here in Dayton, Ohio with Safe Money Partners. Now, before I get into the tax-free options, I want to briefly touch on one of the most commonly used retirement planning tools, and that is 401k. I want to share with you an excerpt from some literature right off of the IRS website. And it reads, with a 401k plan, employees can choose to defer some of their salary. Instead of receiving that amount in their paycheck, the employee defers or delays getting that money. In this case, their deferred money is going into a 401k plan sponsored by their employer. This deferred money generally is not taxed until it is distributed. Now, I didn't read where it said a 401k account had to be used for retirement. Unfortunately, through marketing is reason to believe that certain accounts should or need to be used for retirement planning. Now, let me ask you, could you eat cereal for dinner? Well, of course you could. It's simply marketing that sometimes calls it breakfast cereal. Keep that in mind. But today we're not talking about tax-deferred accounts like 401ks. We are talking tax-free. So how can you set aside money after you pay the taxes and enjoy all the growth into the future without having to worry about future tax rates? Well, your tax-free account options are Roth IRAs and life insurance. Now, some may choose not to agree, but what allowed these tools to be utilized tax-free are rules of the IRS tax code. So let's talk a little bit of the basics about these two vehicles. You take the additional income, you pay the taxes, and deposit it in a way so that you can access the funds and the interest earned tax-free in the future. Distributions from these accounts can be done in a way to not affect taxes on Social Security benefits in retirement. You will not be forced to take required minimum distributions after age 72, which basically how that works, if you don't know, is you have to, with tax deferred accounts, like a 401k traditionally, is you are required to take what's called a required minimum distribution after age 72 for every year that you are alive from there on. Also, in these accounts, you can access funds without penalty before reaching age 59 and a half. And these funds will pass tax-free to the next generation. So let's dive in a little bit deeper on the specifics of the two. So on the side of the Roth IRA, an IRA is an individual retirement account. It's named after a gentleman named Senator Roth. I believe he was a senator in Delaware. Investments that can be made in a Roth account include stocks, bonds, mutual funds, exchange-traded funds, annuities, real estate, and more. You cannot touch the earnings for the first 5 years, but you can withdraw up to the amount that you contributed in those first 5 years. There are income limits, which may keep some higher earners from being able to contribute to a Roth IRA. There is a limit on contribution amounts, which can change annually. If you are disabled and can't work, your Roth will not continue funding itself. So let's talk about some specifics on the life insurance. These would be cash value policies like universal life and whole life. We're not talking about term policies here. You have some options for how your money can grow, also known as cash value. That's your money inside of the life insurance policy. You can have market-linked returns. You could have indexing. You could have fixed interest rates. You could be earning dividends. And one very important piece to understand is you could be taxed on all of your money if not handled correctly. So don't plan on using life insurance without professional support. Please don't get yourself into trouble. It could end up badly. But if you pass early, your beneficiaries receive the death benefit, which is more than the cash value. Money inside life insurance is not counted as an asset when applying for financial aid for college. It's sometimes a vehicle that is used for folks that have a good amount of assets and they want to look like they don't have as much, so they can get more of a financial aid benefit from the college. And it's completely legal. It's just where do you want to have your money and how is it looked at when it comes time for the application for financial aid. There are no income limits or contribution limits on life insurance, depending on how you construct it. And you can take loans or withdrawals to access the funds. And basically, you can access funds without actually liquidating. Typically, loans are used because they're tax-free and you actually are borrowing money from the insurance company. Well, why would you want to do this? Well, you might do this so you can continue to earn interest on your money. So let's say you borrow from the insurance company at 4%, but your cash value is earning 5%. This means that you are borrowing money for your uses, whether personal and business, and still earning interest on those dollars. We also call this positive arbitrage. A lot of large corporation and banks utilize their financing, their cash, and their resources in this kind of way. You can also select a rider to have the insurance company continue contributing even if you become disabled and can't work. Many policies also have critical illness benefits, which pay a portion of the death benefit early on diagnosis of something like cancer, heart attack, stroke, kidney failure. And these are not all the pros and cons of each, but it should help you to really get you thinking about your options. And I want to close with a little bit of information from a gentleman named Ed Slott. Now, to give you a very brief background on Ed Slott, he was named the best source for IRA, individual retirement accounts, advice by the Wall Street Journal. And I was recently on a webinar, this was about maybe 2 weeks ago, and I heard him say life insurance has moved to the top of the list for tax advantage solutions. And what's really interesting about Mr. Ed Slott is he is a tax advisor. He does not sell life insurance.